Hello everybody, it's David France here. So I want to share with you a deal we agreed last week with a motivated seller. So let me go through the numbers with you and show you the types of deals we're working on all the time. So this one has a market value of £65,000 and we managed to negotiate a discount to £55,000. So it's not a massive discount, but you'll see how good this deal is as we progress. So we've negotiated a bit of a discount there. Now we've decided to get a mortgage product which equates to 80% loan to value. So the bank will lend 80% of the £55,000. So we need a small deposit of £11,000 and the mortgage, the remaining amount, is financed by the bank at £44,000. Now a quick note on that. A lot of people might see 80% loan-to-value mortgage product as being quite highly geared. Now, the thing I would say on that is the reason why we go so high with our loan-to-values on our properties is we're quite aggressive with buying. If you're wanting to pay off a lot of your debts and you don't want to have a lot of debt, then you might choose to pick maybe a 70% loan-to-value mortgage product where you put more of a deposit in. But we want to get as high a loan-to-value off the bank so we can buy more and more properties, and I'll be showing you how to do that with this. Now, because you're buying at such a low price anyway and low value, it's a very low risk deal anyway. So we're quite comfortable at getting 80% borrowing. Furthermore, we're getting the borrowing in our SPV, which is our special purpose vehicle, because lots of landlords are looking to get out of the rental market, the ones that bought in their own personal names many years ago, looking to get out because Section 24, the tax changes means you can't offset the interest part of your mortgage against rental income, so it's not as attractive anymore. And if you're a high rate taxpayer, that means you can't offset the mortgage interest relief. Whereas if you're buying an SPV, you can sidestep the new rules and continue to get profit from property, and it still turns out to be a very viable way of building passive income through property. So the rent achievable on this particular property is £500 per month. The mortgage payment is very low at 151. That's based on about 4% borrowing. We can actually get slightly less than that, but for this example, let's use 4%. So £151. And again, that can be offset against the rental income in our SPV, which is great. The letting agent charges at £25, which is 5%. Typically, you'll be paying about 10% to a managing agent, but we've got a really good deal. We've managed to negotiate a good deal. And we also allow about £15 per month on a single let property, simply for things like void periods over the year, if the boiler goes down, things like that. So there's a bit of a buffer there for the single let. Now, this is super simple. We're just keeping this as a single let. We're not doing HMOs, service accommodation. We want this hassle-free. Put it in our portfolio, forget about it, get it with a letting agent and concentrate on doing more deals. So the net cash flow on this deal is around about £308 per month, which is a great amount of cash flow. And so that means your net yield is about 10.4%, which gives you a return on investment of about £41 at 41% thereabouts. I'm running through these numbers quickly, so I may have got them slightly off there, but you get the general idea. You've got about 40% return on investment. I'm sure you'd agree you'll never get that in the banks, and it's a great solid way of getting predictable passive income every single month. Now, it's worth noting we come across these deals all the time, and we can do one of two things. We can trade it onto an investor and charge them a finder's fee as a deal broker. We'll get £3 easily all day long for this deal, or we can put it in our property portfolio and get passive income for the rest of our life from this deal. So let me share with you how we get even more creative and how you can make this even more profitable. Most people will be buying at the full market value, maybe negotiate a few thousand off, but nothing spectacular. And they'll be tying up their money in this deal. And in this case, on this example, on these numbers, we're tying up about £13,450 into the deal. So that means you've got £13,450 tied up. So that's a combination of your deposit, your stamp duty, and your legal fees. So it's going to stand as about £13,450, and you're getting £308 a month in. So some people would see that as a really good deal. However, we know we've made our money when we've bought, we've got a discount, and it means in 6 months' time we can refinance the property or get a further advance. And it means we can pull out about £8,000 out of this deal. Now, what that enables us to do, enables us to use that £8,000 to put to another deposit to buy another property, and this is how you get really good accelerated growth, and you can build a big portfolio very quickly. The more deposits you can get hold of, the more properties you can buy. But in this case, it means you're leaving about £5,000 in this deal. Now, because you're refinancing or you're getting a further advance, it means you are borrowing slightly more money. So your net cash flow will go down by about £20 a month, but it's enabled you to get all your money back out, well, most of your money back out, and you can go off and use that for further deposits to grow your portfolio and buy more property. So it's a great way of building your property portfolio quickly, and not many people buy properties this way or structure the deals this way because they just don't know how to do it. So if you're interested in building your portfolio this year in 2019, or finding these types of deals and trading to investors, then go over to our website, www.portfoliomillionaire.com, get in touch with us, and we'll have a chat and see if we can work together this year so you can do lots and lots of these types of deals. Speak to you soon.